everyone, and welcome to this very timely Forbes Middle East webinar. Today's webinar attempts to answer $1 million or maybe $1 billion question regarding amassing wealth and online trading. We've seen and heard about new wealth that's been amassed simply overnight using online trading platforms. You've also been seeing a lot of advertising, and we're all being bombarded with news and commercials online and offline regarding online trading platforms. Today's experts are shedding light on this question. Should everybody really be investing the way we are seeing? And how does uninformed investing affect the market positively or negatively? I would like to welcome our panelists and speakers, starting with Reem Abou Senior Relationship Manager at CFI. Reem is a Senior Relationship Manager and Market Analyst at CFI Dubai. You've also been a regular speaker at different outlets. We've seen you discussing online trading platforms, so we're very excited to hear from you about how to trade or not to trade. So I'd like to also welcome Ali Malik, Director, Senior Investment Advisor at Bank of Singapore. Ali also has an extensive experience in portfolio management across asset classes. You have an emphasis, of course, on equity markets, and you're also a regular global guest, just like Reem, on international networks. So, and prior to joining Bank of Singapore, Ali used to work for JP Morgan in Dubai, Singapore, and LA. A lot of experience today with our guests. Next is Robert Rolih. You're the owner of the $1 Million Training. Hopefully you're going to give us a piece of that advice. Today, Robert is the international best-selling author of the $1 Million Decision: Get Out of the Rigged Game of Investing and Add $1 million to Your Net Worth. His mission, as he says, is to share what the financial industry does not want us to know about investing. We're going to see more about that today. Robert also was featured on international and global news networks, and he's going to share his experience with us today. I'm going to get to that question, Robert, when we get to you. And last but not least, coming from the Caribbean, Darren Winters. He's a self-made millionaire. He's owner of the Wealth Trading Company. You're a successful entrepreneur, no doubt about that. Amongst the many businesses you have owned, you've owned the #1 investment trading company in the UK and Europe with clients all over the world. We're going to shed light on this today as well. And your company provides training courses in stock markets, Forex, cryptocurrency investing since 2000. You started very early on, and you've successfully trained almost 500,000 people. So with that, I welcome all of your expertise from all over the world. Hopefully, with this amount and number of years of experience, global experience that you all share together, we're going together to answer the top questions that we mostly receive about the issue of trading and amassing wealth overnight, and whether or not this is a myth. I'm going to start with the only lady on this panel. Reem, welcome. We'd really love to hear more from you amidst this bombardment, as I mentioned, of online platforms, and each platform claiming to be the best and the fastest and the most user-friendly. We'd love to know what makes CFI different, according to you, than all the other platforms in the market.
Thank you, Jessy, for the introduction, and hello to all the guests, of course. So, as you said, there has been a rise in the technology and the online world and trading platforms, and people thinking they want to have their own investment portfolio, especially with the situation of COVID, people at home, lockdown, and all this. There has been an extreme rise the past year. Now, based on what CFI or how we differentiate ourselves from others, there are many different companies out there offering the same financial products, offering probably the same service, offering also the same infrastructure. However, to be honest, I've been in the industry for more than 10 years now, and I've went through many stages in my life until I found something that has been the key factor in all this experience that I passed through, which is the client in front of you, or the customer, who's really the main focus here. He's just not he's just not any person or any number. We focus on the client. We focus on a good relationship with the person, whether it was on his choosing, whether it was stocks, whether it was funds, whether it was I don't know, forex, whether it was gold, oil. We try to provide as much as we can a service based on our reports, based on our technical data, based on fundamental data. We have on one single platform more than 5,300 instruments in there, and we do have a dedicated support team. We do offer low spreads. Now, I'm not trying to have a marketing approach here. What I'm trying to say is any company, including CFI or any other company, they need to do their research well, whether it was the regulation, whether it was the real presence, whether it was the number of years and experience. This is what you need to focus on. And of course, we need to focus on the technology that's being very advanced. We need to follow the technology to, as much as we can, make our infrastructure very well supported to handle all the issues, because everyone faces problems. So we need to have very fast execution. We need to have very prompt technology. We have services around the world 24/7. So this is what differentiates us from other trading platforms.
Okay, wonderful, Reem. I'm going to get back to you on the issue of technology and how CFI uses it to help consumers, specifically those who are not maybe experts in trading. So with that idea, I'm going to Ali. You have a very delicate question here. We were discussing just a few minutes before on the fact that almost, I'm not going to say everybody, almost a lot of people are either trading or very interested in trading due to this massive amount of spotlight that we have seen around stocks and making wealth overnight. So in your opinion, what does uninformed stock exchange do to the markets? And can you shed some light on this with examples if you have any in mind?
Absolutely. So, Jesse, just like you pointed out, it's a new phenomenon. It's a phenomenon that we're all getting used to, because when we go back to the old school way, we were always taught to follow the smart money. Now, smart money meant where hedge funds were investing, where other institutional investors were investing, and we were supposed to take the lead from there. Having said that, now the mantra has changed from following smart money to, the saying goes, flows before pros. So you're looking at flows more often than what professionals are saying. While of course we wouldn't recommend anybody to invest while being uninformed, but it is a phenomenon that we need to be aware of, accept it, and learn from it in some cases. So a lot of times I have seen people go on Reddit and online forums and try to see or find their next top pick. Of course, that's not our preferred method or our recommendation, but it is a reality. And the sooner we embrace it, the better it is, because it's here to stay.
So people are just winging it, I suppose. I mean, they're just winging it and investing wherever they feel is their luck, I suppose. But I'd like to know more from you, Ali. How this uninformed decision, people who are not into it, but they are being targeted as consumers. Do they negatively affect the market when they just wing it and trade left and right?
Absolutely. So there becomes a huge detachment from fundamentals to what the prices are really trading at, because the prices are just being as a result of people continuously buying it without giving it much thought. A couple of good examples are companies that had actually gone bankrupt. So their stock started performing better after they'd gone bankrupt. So if you belong to the good old Berkshire Hathaway, Warren Buffett school of thought, you'd be very surprised on why people were motivated behind that behavior. But I mean, while of course not good for asset prices, because it sometimes helps, float the asset prices higher than they should really be, but it's a phenomenon that's here to stay. And retail participation has increased many folds. So instead of locking it away and putting it in the corner as a phenomenon that's just temporary, I think it's here to stay. And the sooner we embrace it and be better prepared, the better it is for us.
Okay, perfect. So speaking about being better prepared, I'm going to take that. Thank you, Ali. To Darren. Darren, a lot of we get this question a lot about, should I buy or should I sell? When should I buy and when should I sell? And a lot of new investors, not necessarily experts, rush to amass new stocks, and then comes the question of, when should I sell it? So what would your advice be, especially to the newcomers, about this question specifically, when to buy and when to exit in the new age of investing, if we can call it this way?
Yeah, I think what a lot of people do is they watch for the things that are trending, taking off, doing really well, and they get in right at the end, just before it crashes back down, which is like a typical mistake. I think when I first started,
although it worked for many, didn't it?
For a time, yes. For a time, if you got in before the end of the trend. But I think a lot of people, they waited until all the hype had happened and it was on the news, everything, particular stocks like GameStop and these other things, and they were getting in kind of just at the end, just before it drops back down. I think it's really a lot of novices, myself included, when I first started out, they don't really know what they're doing. They jump in the market and quite often they do get burnt. It all comes down to just learning strategies that work, learning how to get in at the right time, how to get out at the right time. What I did is I found some of the best traders in the world, literally world trading champions, and I just said to them, teach me what's working, what do we need to do? And a few things that I learned very quickly, a couple of quick tips for everybody.
No, take your time. This is the gold.
So if you're looking for a shorter time frame, like day trading or swing trading, where you're in for a couple of days or a couple of weeks, technical analysis is the most important thing, which is looking at the charts. And there's certain things in the charts, chart patterns, indicators that will tell you when's a good time to get in, when's a good time to get out. And that's all stuff that you can learn. Anybody can learn that. You don't win every time, but you get probability on your side. If you're looking for longer term investing, you want to be focusing on fundamentals, which is things like you want good quality companies, good profits, good sales, all of the main fundamentals you're looking for. And that's to hold things for the longer term and get some really good long-term compound returns. So short-term technical analysis, long-term fundamental analysis is the focus. But also just another very quick tip would be, quite often it's a good idea to do the opposite of what everybody else is doing. And a particular strategy that I use that works really well is, if you see a particularly good bit of news come out about a company or a particularly bad bit of news come out about a company, watch what happens. People normally overreact. So for example, if it's bad news, it drops too far, and then you try and trade as it bounces back up and corrects.
So try and go against the wave.
Against what everybody's doing, but you've got to get your timing right, which is you wait for it to happen, and then you'll see in the chart, it will start to turn. It will gradually start to go the other direction. That's where you jump in, and you can get some very big profits very quickly doing that. It's one of my favorite new strategies. I teach people out on my courses. It really is a great strategy. But yeah.
Okay, I mean, yes, that makes sense. It certainly is not something that you can just do from the first time. Even just trying to find a pattern, as you mentioned, is not something you can just start doing. So let me take that to Robert. The stock market is rigged in favor of the rich and the powerful, and there's only really a few names that, we can all name them. We know them by heart now. They're in the industry, they're on the top 10. And that is it. What is your take on this? And do you believe that trading platforms have actually shifted power maybe back to the general public, people like us, who, not like you guys are experts, but people like me who are not necessarily experts in trading platforms?
Yeah, it has always been like this. The rich and the people who are already rich, they are getting richer. Why? Because they are financially literate and because they know what they are doing. The central bankers in the last 10 years have been basically creating this environment where investors are winning and people who are not investing, they are losing, or they are staying at the same place. So because we have these low interest rates all around the world right now, we have zero interest rates or almost zero interest rates. And we have money printing, and this is basically creating this environment where if you have money, if you are investing, then you are getting amazing gains, and it basically doesn't matter where you are investing. If you are investing in the stock market, you are getting amazing gains. If you are investing in the crypto market, you are getting amazing gains. Also, precious metals, even though they have been going down a bit in the last months, but still, even precious metals, I think that they will do very fine in the next years. So basically, whenever you throw your money, you are a winner if you are investor. And this is the problem, let's say a problem that the central bankers have created, because they don't have any other strategies to fight against this recession that we are in. This means that the rich are getting richer, investors are getting richer, and everybody else who is not investing is basically, poor, and that's it. So that's the situation with rich getting richer. And about the platforms, these platforms, like Robinhood and similar platforms, they enabled regular guys, retail traders, to start trading on their mobile phones whenever they are, and so on. And I don't know. I'm not in favor of this speculative short-term trading environment, because I'm more of a long-term investor. And people who read my books and people who are attending my courses, they are more long-term oriented, and they are not traders, But of course, if you are a good trader, if you spend, I don't know, 3 or 5 years to learn how to trade, then you can win this game. But unfortunately, most people don't. Most people just throw some money into the stocks that are on the news, and then they lose their money, and that's it, So this is basically it.
Yes, I suppose it's fair to say most or a lot of people want to just retire early. So maybe they get into this trading for the wrong reasons.
Yeah, they think that they will get rich quick, but it doesn't happen like this. If you go in, if you try to succeed in business, it takes time, and
Yes.
It's the same with investing. You need to learn a lot of stuff before you can make nice returns.
Yes,
To quote
Yes,
Warren Buffett, he says the stock market is the place where the impatient come to give money to the patient.
Yeah.
So not trying to advocate one strategy or the other, but just sharing something.
Or probably it's the fund management versus speculators.
And emotions, emotions are usually the reason why people lose a lot of money, because they overinvest. They see a certain stock on the news, and then they invest all of their life savings into that stock, and then it goes down, catastrophe, and then they panic sell, and they have huge losses, and this is the story, for most people.
So Ali, now that now that we're getting into some sort of advice maybe that people can take, and Darren mentioned, a short-term and a long-term strategy. Robert also focused more on the long-term and not to look for quick gains. What would be your advice for these people who are maybe fooled in a way by these misleading advertising that we are seeing sometimes?
Has to be very, very careful, but both strategies have some weight to it. So what Darren was alluding to, if I may speak on his behalf, and then of course he can further speak to it himself, is people look at in the short term, they look at a lot of technical indicators. So if you ask me, or some of the things that I look at on a short-term basis, that'll be the RSI indicator, or a MACD, or the Bollinger curve, or things like these that I will look on the charts to see, is it a double shoulder? Is it a death cross? Is it a golden cut? So these are some of the things that I will look at on a short-term basis, and people do that. However, I fall in Robert's camp, and that's where we are. We're actually geared towards wealth preservation. So it's the good old trifecta. And I remember it as a trifecta because at JP Morgan, they literally printed it on mouse pads and gave it to us. So we never forgot about it. It was called FSV. So F being your fundamentals, S being the sentiment in the market, and V being the valuations. So in times like these, we tend to forget about the valuations bit. Is that company really trading at an optimum level, or is it really overpriced? So on the long run, it's all about fundamentals, sentiment, and valuation.
I'm going to write that down: fundamentals, sentiment, and valuation. That is new to me. See, this is how this is how we're getting to the layman's terms. So Robert, if I may go back to you, you're also you're a prompter of learning how to make the strategy or make investment decisions on your own, rather than just someone coming to tell you buy this and sell that. And one of your courses actually says get to know Robert's money making machine investing system that teaches you what to do and how to do it. So I don't want to say have you cracked the code, but what would you say apart from the short-term and long-term strategy? What would you say is that holy grail, if we can call it even that?
The holy grail of investing is simply being able to make own decisions. One of my biggest mistakes in my career was that when I started my career in business, and in 5 years, I started to make a lot of money in my business. And I knew at that time that I should invest a part of the money that I make, but I didn't know how, because I was an entrepreneur and I didn't have a clue about investing, about personal finance. So I just trusted my financial advisors, and I just gave them my money and they took care of it. And unfortunately, they were a bit not quite successful in doing that. So I lost a lot of money there. And that is how I learned that everybody should be learning these things for themselves, because
but do you think that would not have happened had you done it? I mean, we also know, I understand what all of you are agreeing on, that you have to be somewhat aware and financially literate and all that stuff, but you also handed your money to supposedly experts. So there's also something to be said about this area where markets or trading is never guaranteed. I mean, losses will happen, right? No matter how literate you are.
So this is the really important distinction. If you are financially literate, if you understand a bit about the investing game, then you can pick the right experts to help you. But if you are totally financially illiterate, then you are just picking somebody, and maybe this person is not working for your interest. Maybe he or she is working for just for their interest, So this is the important thing.
So Robert, I really like this idea, but I'd like to understand from you, how can you define how can someone say, okay, I am somewhat of an expert, I am somewhat financially literate? How do you define that? You go to business school, you take a course, I don't know. How do you assess?
So the important thing is, whatever you are investing your money into, for example, this can be stocks, this can be Bitcoin, this can be real estate, this can be diamonds, whatever, you first need to learn a lot, about this topic, So if you are investing in, for example, in Bitcoin, you need to understand what is Bitcoin. You need to understand what is driving the price of Bitcoin. You need to understand the risks of investing in Bitcoin. You need to understand the volatility that comes with investing in Bitcoin. So you first need to learn. Maybe watch, let's say, 20 videos on YouTube about this topic. Maybe read a book, maybe read 50 articles about this, or whatever, but just to understand what are you getting into. And then you can make much better decisions than 99% of people, who are just making emotional decisions, because somebody told them to invest in something.
Yeah, or financial. Of course, this is the age of being self-taught on so many topics, not just trading. I'm going to go back to Reem. Reem, we hear also that one of the biggest challenges in trading platforms are the regulations and the security, of course, of personal information. Can you shed some light on how CFI deals with this topic, and how do you guarantee the privacy and security of users' information?
Great, Jessy. I will answer your question and then jump into some comments of what the speakers are saying, because it is an interesting topic, to be honest.
No, then in this case, why don't you join first, and then we'll go to this question since we're in it. Go ahead.
So let me tell you, of course, there are two factors, as Darren and Robert and Ali are saying, the technical and fundamental for a trader to be making a good decision, and definitely some sentimentals as well. However, learning is also something that needs to be done. But the best thing is to diversify, and everyone would agree on that. Maybe if you might as well, like, there's a saying that no one would be taking care of your money more than yourself. Probably if you hand it to a financial or a financial investor or a fund manager, they would definitely invest it in a certain fund and give you a certain return, and you would be there passively receiving the money. But it's also interesting to be involved in that. It's also interesting to diversify your portfolio. Probably have a stock, probably have let's say gold, and probably have a fund as well, an ETF, which is passively regulated or passively managed. You don't need to have like a physical fund manager that you pay billion of dollars for. You can read some books like Robert or Darren has very nice
billion. There are financial managers who make billions. I'm in the wrong industry. Sorry, go ahead.
Oh yes, and you can do that in a short period of time as well. If you read some nice books, as Darren and Robert and Ali were talking, and they have advised a lot of investors, and you might take these advices and put them in a diversified portfolio where you get returns from a fund, you get returns from a stock, you invest in gold, and then you try to evaluate your portfolio based on some technicals and fundamentals that we learn from experts like the speakers that we have in here. So this is something I feel like every investor need to do. Learning curve is always going to happen. Probably watching some YouTube or reading a book is not only the element here. It's every day. I learn something different every day. So I always use it to strengthen my portfolio, to strengthen my investment. Probably a wrong decision here, a better decision there. This is the aspect of diversifying that I believe every investor should do.
Okay, now going back into the other part of the question, which is the regulations and sometimes the complications that come with it, and the security and privacy of user information. We'd like to know more about how CFI deals or guarantees this type of private information.
Well, I tell you, IT is the name of the game.
Yeah.
IT is the heart and the core of the company, because based on the rapid movement technology that we see, you really need a very, very strong IT to secure the data of the customers, to follow the latest trends in technology, to abide by rules and regulations that get updated on a regular and daily basis, especially with the hacking that you see, with the loopholes that you see, with the breaches that you see recently, and with a lot of fraud and all this. So we need to have our IT on top of the game to secure the data of all the investors. And there is always a process in there that we do, and we dedicate a whole big team for that. And they have continuous training sessions and all this to secure that we have a well-developed IT department, and they do abide by the due diligence and all this to ensure an ultimate confidentiality.
Yes,
that's the word. Thank you. For of our customers, of course. So this is what we basically rely on, and that's also where you feel secure when you are regulated by top authorities of that country. We have 6 regulated jurisdictions around the world, and they are regulated either by the central bank or the regulatory authority of that country. So sometimes when investors come to open a portfolio, we might ask by a lot of compliance. There is a big compliance department here. It might take some time, but it's make them feel secure that there is someone they can talk to, that we do have a dedicated relationship manager for each client. So that's also something. And the regulation makes it all, like, we've been in the market for 23 years. That makes it all reliable. Definitely, I go back to using the tips and tricks of the speakers that are really giving us really nice information here.
Great. So I'm going to go to maybe a basic question, and I'm going to toss that over to Darren. There's thousands, obviously, of companies trading. How does someone choose where to start from? I hear a lot of people they who are not experts, they just start from their own interests. If they're into cars, they go into that industry. If they're into sports or technology, they just go based on sometimes their hobbies and not necessarily some sort of a process or a system. What would you say to help someone start on this way, and what are the investment indicators?
Okay, so Jessy, if I can also jump back to the conversation the others were having as well, first of all.
Yes.
But yeah, and then that question
yes.
about how people should get educated and learn about investing rather than trust it to an advisor. something which I thought very early on, why don't people teach this in school? Why, as kids, why aren't we taught like basic financial education? And it's something we started doing a few years ago, is we now teach children how to do this for free. We run free courses for like 10, 11-year-old children. And what I found is it can be taught in a simple way. A lot of people, what they think is, well, if you want to get good at investing, it's going to take years and years and hard study and reading lots of books. And that's not true. If you learn in the correct way, if you learn the right strategies, I've had children, 10, 11-year-old children, after 3-4 hours going into the markets, demo trading and getting great returns, just because they learned the right strategy. So if anyone out there is thinking, well, it's going to be such a hard process to learn, it's not if you learn the right way. And then just to go back onto your good question there about how do you select the right stocks? How do you select what to trade? Again, for fundamental analysis, you want to be concentrating on the companies, basically looking for good quality companies. Are their sales growing? Are their profits growing? Check they don't have too much debt. You're looking at all of the financial details about the company. And there's tools on the internet, free tools that you can use that will do screening for you. So you can type into the criteria, I'm looking for companies with this much profit growth or this much sales growth, and it will automatically find them for you. So it saves you loads and loads of time, and you can focus in on the best quality companies for some really good long-term growth. And of course, as we said, you do want to look at the technical as well, because that gets your timing right. So you get into at the right time into the companies. And that would be things like indicators. And there's various different indicators that work very well. I think a few were mentioned already, things like RSI, CCI, things that will just give you a kind of head start as to getting in just at the right time. And all of that stuff, fairly easy to learn how to get your timing right. But also focusing on strong sectors. There are sectors that we're doing particularly well, like right now, the last kind of 5, 6, 7 months, technology has been doing incredibly well. Just the trend is your friend. Jump on the trend until you see things start to change, until you see the indicators start to change, you see the charts start to change. You can ride these trends.
But that is it, Darren, isn't it? You don't, in so many cases, you don't see it starting to change. It just abruptly changes. You just wake up in the morning and some companies' stocks have crashed. Does it really give you a pattern where you feel like, oh no, it's going to change, let me get out?
Yeah, I would say almost always you can see it before it happens. If you look back at all of the stock market crashes in history, every single one of them was entirely predictable. You could see it days or even weeks before it was going to happen. There was various indicators that were telling you it's about to happen, and then in the chart you'd see it start to happen. And people say, hey, this sector went up and then it just suddenly crashed. Very rarely will it just suddenly crash. It will drop, it will go back up, it will drop again. There's lots of warning signs. So if you know what you're looking for, you can almost always spot when this is about to happen.
Interesting. Okay, that's a very interesting point. I think if nobody wants to comment on that, because some would say that the only reason a lot of people are surprised of a certain crash in a certain market is because of greed. They wanted to stay there longer because they think they could make that, last few million before they run out of the game. Okay, with that, I think we get into our
history repeats itself, as Darren was saying, Jessy. Like, we've seen a lot of trends back in 2008 and all those crashes. Just we are seeing the same thing again. In I think it was 69 or 79 when Richard Nixon removed the peg of the gold to the dollar to gold. The market crashed. We're seeing this happening all over again. However, big investors, they don't want the crash to happen right now. That's why, as Robert was saying, that they're printing that cheap money in the stock market to just make it all go up, make it all grow, because they want people to invest. And if the crash is not going to happen now, probably it might take some time before it really drops. Reason being, as they said, the low interest rate, the printing money. Reason being, people are moving from growth stocks to less expensive, because the growth stocks like Tesla or Apple or all this big technology, they're over budget right now. The prices went very high, so people are going to the less attractive sector that's going to open right now with the open of the economy, like probably operations or transportation, or even, you know, like the industrial stocks that are less attractive, that were less attractive past year. They will be
I
having
suppose
those.
Healthcare is seeing a spike. Of
Healthcare
course,
as
in the
well.
past
Yes,
year.
you're definitely right.
Yeah.
Probably Johnson and Johnson, if people are listening, is the
Yeah.
next stock that's going to hike. I mean, that's Darren, correct me if I'm wrong.
Do you agree? Has it hiked already?
That is quite likely.
Yeah. So yeah, it's interesting. It's an interesting industry, and it's really nice to be part of it. As everyone was saying, it's really nice to try and grab the opportunity. And as Darren said, and Robert, trend is your friend, or follow the trend. Like if the trend, people would say, okay, the trend is going up, definitely now it's overbought, let's sell it. But why? But it's going up. Or why do I want to sell right now? It's not the right time for entry position. So there's a lot of tricks here with technicals, definitely, and fundamentals.
The interesting thing in the investing world right now is that this bubble that you are living in, it's a bubble. You know, everybody knows it's a bubble because of the money.
But it's not going to burst.
But it could go on and on and on. It could go on and on. And if you are not investing, you just have your money in the bank, and bank accounts give you zero right now. So if you account for inflation, and the real inflation is much higher than the reported inflation, then of course you are losing a lot of purchasing power. So basically the entire macroeconomic picture of the world, and central bankers and everybody is forcing us to invest and to be a participant in this bubble. But you need to be, because otherwise you are losing a lot of money, you know.
I think one of the
I love how he laughs at the end, sarcastically. Go ahead, Darren.
One of the most important things that we haven't mentioned yet is when you do get into an investment, use sell stops, to protect your capital in case something happens. And as these stocks go trending up, you keep moving those stops up to lock in profit. And then very quickly, if you're moving a sell stop up, you've locked in some profit, and whatever happens next, you're okay. You've guaranteed you made a profit on the trade. So protect your capital and then lock in profits quickly, especially now the market is in a big bubble. Everything's overvalued, everything's overpriced. Just make sure you're in a safe position, and whatever happens, you're gonna make some profit.
All right, we're getting close to our closing remarks, so I'm gonna go a little bit to Ali real quick. Ali, we heard a little bit about the technology sector, the healthcare sector. What stock types do you see improving in the short and the long term? And do you advise all these high-profile clients, basically? I mean, what would you say are your predictions?
At the moment, we are looking at industrials, energy, and financials. So basically cyclicals. So quite prudently, a little while ago, we made this transition where we moved from growth, high octane names into value and cyclical names. And that's been a very good move through the course of this year, especially with energy prices stepping up, financials having a great time. And now with what seems like unlimited fiscal stimulus coming in, I think that will be further beneficial for infrastructure plays and industrials going forward. So three of the things that I'm looking at is cyclicals, and within cyclicals, financials, industrials, materials, even real estate. There's some of the names that I'm focusing on. So not as much tech as others are saying. We remain neutral on tech.
Interesting. Neutral, you said?
Yes, neutral on tech, yes.
Well, why is that? May I ask why?
I think it's very fully valued. If you see how it's really been the decade of tech, so to say. I mean, if you look at NASDAQ's performance, it's just had a very stellar run. So it's fully valued. So that's why neutral, because we just see more upside on the conventional good old names, the cyclical plays.
Yeah, that makes sense. Okay, if I go to Robert with that, what would you say are the best financial products maybe to buy in times like these, and which ones to avoid at all costs?
So maybe, which ones to avoid first? I try to avoid all of the financial products that have really high commissions and fees. Because I'm a long-term investor, if you have a very high, for example, management fee, like 2 or 3% per year, then this will eat up most of your future returns. So for the long-term investment products, you should always check what kind of commissions and fees are you paying, okay? Because they are, you have this accumulation, you know, of the profits, and it's the same with commissions and fees. So in the long run, a small 2 or 3% management fee, annual fee, can eat up most of your future gains. So maybe this is the first part of the answer. And then I really like to be invested in multiple asset categories right now, because we live in a very uncertain world. You never know what will happen with the inflation, with the interest rates, with central bankers, with macroeconomic flows and everything. So you never know what will happen. And that is why I like to be in stocks, I like to be in crypto, I like to be in precious metals, I like to be diversified. Okay, and this is I think the most important thing, because nobody knows what can happen, you know, and there can be a lot of black swan events that nobody can predict.
Although Darren says they're always predictable, but I'm gonna leave you to argue that after this.
Can be predicted, but you know, nobody could predict very few people could predict the financial crisis. Very few people could predict like some kind of big COVID events, you know, like COVID, pandemics and stuff like this. Nobody could predict these kind of things, you know. So that is why they are called black swans, because they are rare and they can come from out of nowhere, you know. So you never know. You need to be diversified into different asset categories because you need to understand that you cannot predict everything.
Darren, you want to address that before I get to the last question with you, and then I go back to Reem?
Yeah, absolutely. So what you want to do is you're using all the tools you've got, all the resources you've got to predict what's likely to happen. As I said earlier, you never win on every trade. That's, of course, that's impossible. You're getting probability on your side. That's what it's all about. Yeah. And once you've got probability on your side, the more you trade, the more money you make. You don't win every go, but you don't care. That's the goal of all of this. And like Robert said, of course, there are these events, black swan events, that are totally unpredictable, like COVID. Nobody knew that was going to happen. And when things like that happen, what you've got to do is trade the reaction. You've got to let whatever's going to happen, and then you trade it as it corrects the reaction. So with COVID, there was a massive stock market crash. And then what happened? It bounced back up. Yeah. And that was the bit that you needed to be looking for when things started to turn back around and start to bounce back up. Even though you couldn't predict the first event, you could certainly predict at some stage it was going to change direction, head back up. And that's what you needed to be looking for.
So if I were to ask you the final question, which is before I go to Reem, I mean, you've mentioned already a lot of advice. If we were to sum it up maybe and say, and I'd ask you, what are your top tips really in trading in this volatile market? And I don't know if the term here volatile is suitable for this market, but what would be your top tip?
Okay, yeah. So in the volatile markets now, certainly.
First of all, you agree they are volatile?
Yes, I mean, I'd say not overly volatile. In historically, we've had markets like this many times before. They are maybe a bit more volatile than they have been, but certainly, like Robert was saying, you want to be diversified. That's important. You want to have your money spread out across different asset classes. And also what I would say is you want to be in up and down trades. You want to be in trades where you're short to make money as they drop. You also want to have some of your portfolio in trades to make money as things go up, because that way, if there is some unpredictable event and you get a big drop in the markets, half of your portfolio is going to be making you a lot of money. If you're in some down trades, you're in some short trades. And a lot of people, they forget about playing stocks and shares to make money as they drop, which I think is an important part of any portfolio. You need to have this balanced portfolio. And if you're picking the right companies, your companies to make money going up can be making you money. Your companies to make your money going down can be making you money as well. And you're also in a really strong position if there is a big move in the whole market. So I'd say be diversified, get a balanced portfolio, and that's really kind of the safest way to go about this.
Okay, I think Reem is going to agree. Go ahead.
Yeah, I'll jump in here, Jessy. Exactly, you knew it. What Darren is saying is absolutely what CFDs is what the derivative market is. Okay, so basically what people, they can go short, they can sell as well. This is what a concept that a lot of investors don't get. They think that I need to buy to follow the trend of a stock going up. So the sell position is actually what you're trying to do, is working on with a contract for difference. So you're taking advantage of the price moving down, or you're taking advantage of the price moving up. Okay, so you don't actually own the stock, you're working with an underlying stock. That's how you can take advantage of a short position. So that's where you come in, jump for short term, just probably open a trade when this US stock market opens, because big investors and big players already dropped in their analysis in there and their trades. So you can just follow in with probably if you want to be a fundamental trader or a fundamental scalper, you can just jump in, go short or go long based on whatever is coming out, and then be a viewer in the market. So this is if you don't really want to go deep into analysis. This would be a bit risky. This is why CFDs are risky, but they also have higher returns. Okay, this is again where the diversification comes in, not only short term and long term, but also going short and going long, also keeping some stocks for a long term for a long return, also going in and going out in the same day, probably making a couple $1,000s in a day, or in probably an hour. This is how you want to be part of the game. This is how you feel like you are taking advantage of or making profit and taking part of the Wall Street and all this. You see, I don't know who talked about GameStop or the small stocks in there that we've never heard of, and suddenly they just jump in. This would tell you that there is a shift in the Wall Street or in the stock market from big investors like Warren Buffett or the like, to small investors that are really affecting the market. We can make a difference in the market by just the number of volume that we're investing. So that's why individuals are really getting interest in this kind of trading, because they can affect, they can do something about it if they follow what's going on in the market. So that's,
it's certainly been an interesting news cycle, let's say, when it comes to trading. I'm going to leave the last question with you, Reem, as well, because we've also heard a lot of platforms crashing, going offline, basically due to load issues, crashes in the servers. There's a lot of risk. Although you mentioned that technology and IT are at the core of your industry, how does CFI plan to face this challenge and save investors from this risk, which is everywhere, really, in every platform?
True, Jessy. As much as we say technology, of course, it cannot be perfect. There are always going to be flaws. There are always going to be catches here and there. However, what we try to do is get our systems in check, 99.99% up and running 24/7. We do try to have very, very fast execution, not to have any delays. We do have straight through processes with investors. To be honest, at the end of the day, the investor is never at loss, even if I don't mean about profits and losses, but what I'm talking about is, let's say if the system crashed, it happened to us a couple of times. We reimbursed clients on that because he was at the right, he had the right to receive those profits, let's say. So we did reimburse, and very rare companies that do reimburse on some losses for clients. So this is something we do. If we do believe that the client is the core of our business and he's the center, and we want them to be satisfied. We just don't want to load in more people. We want quality in there, and we try to follow the service and the as I told you, the IT department and engineers that are always up and running 24/7. This is something when it comes to SLAs or fast executions that has been actually feedback and statistics from our clients. That's something really was on our advantage.
Okay, that makes sense. Anybody has any concluding remarks before I end, and by trying to summarize all the interesting tips you had? 3, 2, 1. Nobody has. Go ahead, Robert. Yeah.
So I think that the most important thing when it comes to investing, and also other areas of life, is to constantly learn new stuff. Let me just give you one example. Warren Buffett. Warren Buffett has a very, very poor performance over the last decade. And why? Because he totally missed out on the technology boom. He didn't invest in these big technology giants that we all know right now, you know, like Tesla, like Amazon, like Google, and so on. He only started to invest in Apple in 2016. Why did he miss all these big names and big stocks, you know, that could provide huge returns for him? Because he was a bit afraid of the technology, because he didn't understand the technology. He didn't understand the business models. So he was just he just stayed with all the traditional companies that he bought throughout his career. And if you just learn about new technologies, if you learn about new stuff that is coming, you know, that is being in development and so on, you can come across a lot of amazing investment opportunities that people who are not learning constantly, they will never get across, you know, these kind of ideas. So learn all the time in business, in life, in investing.
All right, a lot of things to be summed up, but I'm going to attempt to do it really quickly. We took a lot of valuable advice from you and from your expertise. You almost all of you agreed that trading is something that can be done that cannot be done really overnight. You must invest in yourself first and learn the fundamentals and think of a short-term and a long-term strategy. You all agreed on the point of diversifying and the importance of diversifying your portfolio and having a balanced look and approach to trading. None of this overnight gains that we hear, especially if you're new to this field. You all also talked about and Robert stressed on the importance of being financially literate, educating yourself, finding tons of resources. Darren mentioned free resources that are out there. At least it's a good way to start. It's a good point to start to know where you can grow from there. Reem stressed the issue of diversity as well. And Darren talked about offering basic financial education in schools and primary education. You talked about Darren and Robert have had a bit of a different perspectives. Basically, Darren mentioned that all of the crashes we have seen could have been predicted or are predictable if you know a thing or two about markets. Robert says that's not always the case. There are some cases where nobody could see it coming, like the recent what happened in the COVID or healthcare pandemic. Nobody saw it coming. Of course, Ali's FSV is something I wrote down. The fundamentals, the sentiment, and the valuation is something that Ali gave us, which is also a great insight to keep and as a takeaway. I'd like to thank you so much for enlightening us and giving us such insight, and giving me personally such insight on the topic of trading and trading platforms, and how it's now an available tool for honestly everybody, whether you're an expert or not. The key is to teach yourself and find the correct resources and the correct experts and platforms to help guide you on this road. I'd like to thank Forbes Middle East for organizing this webinar in exclusive partnership with CFI. Thank you so much for joining us, and we'll see you in the next session. Thank you, everybody.
Thank you.
Jessy.
See ya.
Thank you, everyone.